Hello and welcome to the Switzer Investing Masterclass on Investing for Growth. I'm Paul Rickard. Joining me today is Chris Bedingfield, the Principal and Portfolio Manager of Key Global Investors. Chris, welcome to the program.
Thank you.
We're in a really interesting point in markets at the moment. We've had equity markets up near all-time highs, interest rates are near all-time lows. So how does an investor like you approach offshore markets at the moment?
It's certainly an interesting time. There's plenty of uncertainty in the markets, although there's always uncertainty, I guess. But at the moment, I guess one of the things that's really unsettling markets to some extent has been, the prospect of higher interest rates. As you say, interest rates around the world have been very low for some time. And now there is the real prospect that the US in particular is thinking of increasing interest rates. There's also been the uncertainty of the fallout of the Brexit vote, of course, and we have elections coming up, particularly in Europe next year. So it's certainly an interesting time to be looking at global markets, but at the same time, there's lots of opportunities as well.
So let's talk about interest rates. They have been at record lows, just started to tick up a little bit. But how have you been approaching investing in real estate with interest rates so low?
Yeah, it's an interesting question because real estate quite often gets lumped into being an interest rate sensitive sector or a bond proxy, if you like. And the conventional wisdom is when interest rates increase, real estate does poorly and vice versa. The data doesn't necessarily play that out necessarily because if you look at the United States, the last interest rate rising cycle, which occurred from 2004 through to 2007, I think rates went from around 1% through to almost 4.5%. US real estate companies, listed US real estate companies, increased in their total return was over 60% during that period, and in fact was roughly double what US equities was doing. So what people sort of tend to forget when it comes to real estate is they are a growth asset as well, and if interest rates are increasing because the economic outlook is improving, that is actually a net positive for real estate. So the way we think about it is we look for investment opportunities where there's a bit of a demand-supply imbalance, where underlying demand for space is greater than overall supply, and that's usually a positive for real estate because landlords can push rents and they can grow their cash flows.
I want to come back to the supply and demand and the growth characteristics in a moment, but with a lot of talk about US interest rates going up later this year, does that mean you're not worried about that?
It's one of many factors to think about. Clearly, in some asset classes, there is a risk that some of your exposures may be exposed to that environment, and a good example of that would be real estate companies that have very long leases, very certain cash flows, contracted rents. Healthcare is an example of that, where they don't really benefit that much from an improving economic cycle. If the US economy improves, people aren't going to get more sick.
No. So you mean things like hospitals and...
Yeah. So those sorts of assets tend to be a little bit more exposed. But the other side of the equation, if office or retail, or particularly apartments and rental apartments, they would tend to do quite well in an improving economic environment. So we look at interest rates, but we look at also the underlying bricks and mortar and underlying demand and supply.
Okay, so you mentioned that the property is a growth asset, supply and demand. Is supply and demand the main factor that drives your view about different property assets and how you invest? It's
one of many factors we look at. Clearly, there are situations where demand can be much greater than supply and the fundamentals can look great, but at the end of the day, we still want to buy underlying companies and the underlying real estate at a good price. And so we look at other factors as well. We do a lot of work on valuation, for instance. One of the metrics we like looking at is price relative to replacement cost. So for instance, if it costs $100 per square metre to build an industrial property, we would be loath to be investing in a company where the underlying assets we're paying $150 per square metre. We want to be paying a discount.
Yeah.
So we look at those sorts of elements as well.
Now, you're a global investor, you're in a global real estate fund, so what are the countries or geographies that appeal most to you at the moment?
I guess in terms of where we're allocated, we've got around a 60% allocation to the US. We find that a very attractive market for a number of reasons. Counterintuitively, it's because they tend to have higher interest rates than certainly other parts of the Northern Hemisphere, and that means the dividend yields tend to be higher, and that means we're probably going to get a better total return, starting with a higher dividend yields. So the US is an interesting market. We like Canada as well. Canada is very similar to Australia in many respects, a floating exchange rate. It's had a bit of a shock in terms of the oil price recently, but at the same time, a lot of the real estate there is trading quite cheaply in relative terms.
And what are the markets you're not favoured towards?
So we're not in Japan. We find that a very challenging market, mainly because the pricing, the yields are just so low.
Yeah.
It's understandable for local investors to chase those yields because the alternative return on cash is so low. But the beauty of having a global mandate is we can say, well, we just don't want to be there.
And Europe?
We find Europe interesting but challenging as well. It's got similar issues in that interest rates are very low, but the underlying economies are a bit patchy. And so while there are some opportunities in Europe, and we have one investment in Europe, it's around 3% of the fund, we find that a combination of valuations being very full and underlying weakness and uncertainty in the economy, we find more opportunities elsewhere.
Chris, your global real estate fund has some very specific objectives. What are they?
So our objectives in the fund is to deliver a CPI plus 5% total return to our investors over a 5-year period. We do that by identifying real estate, global real estate, where the vast majority of income is generated through lease or contracted rents. So we try to do it in the lowest risk manner we possibly can. We also do it by running a relatively concentrated fund. So the fund at the moment has 24 investments around the world. Compared to others, that's relatively concentrated. But we find that gives pretty good diversification. In fact, the portfolio is invested across 10 different types of asset classes, from student accommodation to healthcare to retail, office, industrial and storage. So we have pretty good diversification, and the objective, as I said, is 5% over.
And you're an index unaware manager?
Yeah, so our starting point is really to find the best investment propositions globally, whether they're the biggest in the market or whether they're not so big. Our fund is exposed to some very large companies around the world, Ventus and Scentre Group, very large companies in their own right, but we also look for opportunities further down the scale as well. So the beauty of being index unaware is we can really just try and find the best opportunity.
So Chris, how do I invest in your fund?
Well, you can access it through certainly coming to our website, keygi.com. We're also on the Hub24 platform, or certainly through your broker, through mFunds.
Chris, thank you for sharing those insights, particularly around interest rates and its impact or lack of impact or potentially on the property market, and how you approach investing in a growth asset like property. Thanks for joining us on this Switzer Investing Masterclass on Investing for Growth. I'm Paul Rickard.